Chapter 9 is entitled Costs Matter, and the subject of it is essentially mutual fund fees. Now, this isn't a chapter you might find incredibly exciting, but it is extremely important because the higher the fee you pay, in all likelihood, the lower the return you'll get. And mutual funds can potentially charge quite a few different fees. There are plenty of funds that don't, and I just want to show you how to find out what fee they pay, how it's all going to add up over a lengthy time period, what types of funds to look for in terms of fees. So, there are certain fees that are covered on the prospectus. So I'll say they're listed in the prospectus. And I've actually never shown you a prospectus, so let me do that. And I hadn't actually planned to. I open up a lot of screens before I start recording my lectures, and I didn't get that screen open. So I picked this particular fund for a reason, and related to their fees, but I'm going to go ahead and see if I can find their filings. So, every fund is required to report certain information, like the name of the manager, the experience they have, the returns the fund has generated, its objective, like what types of assets does it invest in, and they will report that information in something called a prospectus, which is just a document. And here's a summary of the document. The actual prospectus is usually pretty long, and they create like a single page summary. And I'm going to see if I can just, hopefully, this will just open. And I forgot what I was talking about. Okay. So in the prospectus, they have to list their fees. And well, I lost it, so I'm just going to click it again. There we go. And so if I dug through here, and actually it's actually on the front page, so I can see the fees that they charge, and this probably doesn't mean a whole lot to you right now, but as I go through chapter 9, it should. And it's a lot easier to find the fees on Morningstar without going to look at the actual filing and the summary prospectus. So this is where Morningstar gets the information, and then it puts it into its database and pops it up on different screens when we search for the fund on Morningstar. So, as part of the prospectus, the mutual fund is required to report certain information, and then Morningstar will dig through it and report it in a more easily found format. But the first set of fees are called load fees. So I actually want to create that as a separate. Actually, I guess I'll do it here. So they're called load fees, and there are two types of them. There's what they call the front load. This is kind of an old term. They don't usually call it that anymore. Now they call it a sales charge. But it's charged when a person buys shares in the fund. So anytime you add money to the fund or initially purchase the fund, you'll be charged this fee. And right now, the max that they're allowed to charge is 5.25%. So if a fund charges a load fee, in all likelihood, it's going to charge that max. What that means is if I deposit, I'll just make it $1,000 to make the math kind of easy. So if I deposit $1,000 into shares of a fund that charges a 5.25% front load, I just use that term because that's how I learned it. But again, most people call it a sales charge. What this means is not all of my $1,000 will go toward purchasing shares of the fund. They're going to take 5.25% right off the top as a fee. I'll never get that money back. So I'm going to go 0.0575, sorry. I'm just glancing to see if it's 25 or 75. I'm going to take a quick look here because I know one of these had one. Not that one though. I've got to look at it here. Oh, that one doesn't charge the the full amount. I know it's more than 4.25 though. I think it is 5.25 and not 5.75. But at any rate, 5.25% of my $1,000 will immediately be deducted. So that is $52.50. So they'll take that and keep it. And this results in only the rest, which would be 1,000 minus 52.50, which is what, 947.50 if I did my math right. Only $947.50 will be used to purchase shares of the fund. I don't know about you, but I would find it frustrating to immediately give them $52.50 as a fee from my $1,000. That also means then when I earn a return, I'm not earning a return on the 1,000. I'm earning a return on only the 947.50. So that's going to result in a lower dollar return than if I could have earned the same return on 1,000. So that fee is going to impact you from the time you purchase your shares forward. All right. So your goal should be to avoid front load funds. You'd think I'd get better at typing, but I don't seem to. Now, there's also something called a backload, or it's also called a deferred sales charge. And this is charged when you redeem your shares or cash in your shares. So basically, let's say I've kept my money in a fund and it's grown to be worth $15,000. I don't know. I'll make it 10,000. Math's easier to do. So it's worth $10,000 in shares, but there is a 2% deferred sales charge. If I cash out all $10,000, or if I want to cash out all my shares, which are worth in total $10,000, I will only get 98% of the 10,000 because the 2% they keep. That's just part of their deal. So I'll only get 98% of my total value. Oh, I wish my typing were better. So I got shares worth a total of $10,000. I only get to keep one minus that 0.202, which is 2%. So I only receive $9,800. So I lose $200 in a fee when I decide to sell my shares. So avoid funds with deferred sales charges. It used to be that it was difficult to find funds that didn't have load fees, but over the last 30 years that's changed a lot. So now there's probably more funds without load fees than with them, or maybe they're about equal. I've never really looked, but it's just, I mean, from my years at looking at mutual funds, it seems as though fewer have load fees than don't. I think I said that right. Now, with respect to these deferred sales charges, I'm going to add this here. Some funds have deferred sales charges that slowly fade away. So if you hold the fund, let's say for 1 year, they'll lower that deferred sales charge percentage. And if you hold it for 2 years, they'll lower it even more. And eventually, maybe after you've held it for 5 years, it'll completely go away. So that actually gets to what I'm going to call a side note. And I don't to do that with it. So, as a side note, mutual funds have some mutual funds have different classes. And the three most popular classes are Class A, which those have front loads but no back loads. Class B funds have a deferred sales fee or charge that will slowly disappear or fade away over time. So that fades the longer you hold your shares. And so essentially it converts once you've held your shares however long that time period is, and it could be different for different mutual funds, but once you've held them long enough that your deferred sales charge goes away, it basically converts to a Class A fund. And then there are Class C shares, which have a deferred sales fee that never fades. And again, not every mutual fund will have all these classes. But if we pop over to Morningstar, this is why I had chosen this particular fund because it does have different classes. This is the Class B. And if you go to purchase, I'm going to zoom in a bit, you'll see that here's their Class A with that front load, here's their Class B with the deferred load, and it's a high deferred load, but this goes away if you hold it long enough. And then here's the Class C with a smaller deferred load that will never dissipate. And then their expense ratios are different, and I'll explain what that is in a bit. This fund also has other classes as well, but the three main classes, if a fund has different classes, the classes that it will have will probably be A, B, and C. But the other classes have restrictions, like sometimes there'll be an institutional class which has a huge minimum investment, maybe of $1 million or $5 million. Sometimes a mutual fund will create a class that's geared for people who participate in a specific company's retirement plan. And so that would be restricted to only people who work for that specific company. Sometimes they'll have a certain class where they restrict it just to members of a certain ethnic group or a religious group, which is interesting. But they do that because certain religions have certain restrictions on types of investments that they can make. So those may or may not apply to you. So I'm only going to talk about A, B, and C. All right. And so now back to our fees again. So there are only two types of load fees, the front load and the back load. And so now I'm just going to go other fees. And I'll start over with my numbering. All right, some funds have what's called a redemption fee. Deferred deferred sales charges are charged to try to convince shareholders to hold their shares for a fairly long time period. That means the fund can spend more time managing your money and earn a higher management fee, which I haven't discussed yet. And in the Class B cases, they will reward you for holding your shares for a longer period of time by making that deferred sales charge go away. But sometimes people like to time the market. They do a lot of trading, buying into the stock market via a mutual fund when they think the market's going to go up. If they think the market's going to drop, they'll redeem their shares, cash them out, and invest them in, maybe just even put the money in their savings account because at least they can earn a small positive return on that versus a negative return if the market actually drops. So people who try to time the market are always redeeming shares, then when they think the market's going to go back up, putting their money back into mutual funds. And they do that all the time. And that's a hassle for the mutual fund. So they try to prevent that from happening by charging a redemption fee, which is essentially a fee that's charged when you redeem your shares. if you've held them for a very short period of time. And that by short, I mean 60 days, 90 days, so a very short period of time. So I'll say 60 to 90 days. So that's not quite, I mean, even though it's charged when you cash out, it's not really a long term deferred sales charge fee, so they don't classify it as a load fee. To tell if a fund charges such a thing, if you go to the expense portion under Morningstar, it will say right here whether or not they charge one. And this particular fund doesn't. I believe Vice X does, so I want to show you one that does so you can see what it looks like. So again, under the expense ratio, here they have a redemption fee. If you sell your shares and you've only held them for 60 days or less, you'll be charged a 1% fee. And that's 1% of the total value of the shares you cash out. But if you hold them for more than 60 days, that goes away. And it doesn't have a sales charge, deferred sales charge, or an initial sales charge. That initials that. This is the front load, this is the back load. So if a fund has a redemption fee, that's not necessarily bad if you don't plan to sell your shares before that time period is over. Some funds have a purchase fee, which is a one time fee that's charged when you open your account. There are some setup costs for an investment company like Vanguard to opening your account. You have to attach a bank account with it. They send you a tiny little bit of money so that you can look at your bank account and see the dollar amount and input it into the website for Vanguard just so they can verify that the transaction actually worked and it's the correct number to the bank account and stuff like that. And they charge you maybe $30 or so as a one-time fee. I mean, it'd be better if you didn't have to pay that fee. And they might forego that fee if you agree to do all of your transactions with them electronically. So they're required to provide you with information about the mutual funds you purchase. And if you actually want that information in the form of a hard copy, that's more expensive for them to print and mail to you. But if you agree to just having electronic copies, that's a lot cheaper. So maybe they'll not charge you a purchase fee if you agree to only electronic documentation. Some funds charge you an exchange fee, and this is really a switching fee. This, not every fund has it, but it may be charged if you want to. I should not say when, but if you want to switch shares from one account or mutual fund with Vanguard to another. So let's say I have um, like my daughter has some money in four different Vanguard accounts. She has an international larger company fund, she has a US larger company fund, she has a small cap US and a small cap international, I think. And let's say the small cap international does really, really, really well, and it becomes a huge portion of her portfolio, much larger than I think it should be. And so what I'd like to do is switch some money from that small cap international into, let's say, large cap international. And that would require that I sell some shares of the small cap international and use the cash to buy some shares of the large cap international. They may charge, they don't, but they could charge a switching fee for that process. So, charged if you switch some money from one mutual fund of that investment company. And by investment company, for example, I mean Vanguard, into another mutual fund from the same investment company. I don't know, my typing is worse than normal, but it's horrible. I mean, ideally, if you plan to do a lot of switching, I would look for a company that didn't charge a switching fee. And like I said, Vanguard does not, as far as I'm aware. And so I think I'm going to do is just color code these. So the ones that I'm putting in yellow, not every fund will have this fee. And also not every fund will have this front load. I'm just going to highlight load fees because that includes both front and back. But every fund does charge a management fee. So every fund charges this, but there's a big difference in management fees across different types of funds. So I'll say a lot of variability in how much it is. So index funds and ETFs typically have very low fees. So let's go look at some. So I'm going to compare the Vanguard 500, which is an index fund. I'm looking for Morningstar. Here we go. Actually, I've got the VICEX fund up right now, so I'm going to just pop that number up. And the management fee is part of this expense ratio. They actually break it down, but for now we'll look at this. So 1.44% is how much they charge of the total value of your portfolio per year for the Vice X. So I'll jot that down in a minute, but let's look at the Vanguard 500. They only charge an expense ratio of 0.17%. And I've seen lower numbers than that. Um, gosh, I don't know if this is actually gonna show. So I'm gonna look for this one. I'm looking for an ETF for Vanguard, and I can't think of what it's called. Here we go, the Vanguard Total Stock Market ETF. So I just want to show you the expense ratio on it. 0.05 point yeah 0.05%, so that's even lower than 0.17%. So ETFs have very low fees. So 0.17% for the VFI and X, and then the I can't remember the ticker on that one. The VTI, the Vanguard Total Stock Market Index ETF, was 0.05%, but the Vice X, which is an actively managed fund, had a ratio or expense ratio of 1.44%. So these two are in an index fund, an ETF, and then an actively managed fund. So huge difference. Actively managed funds have a lot more work to do. They are trying to find stocks that they think are undervalued or overvalued, and then they're constantly reviewing the investments already in their portfolio to decide is now a good time to sell them. And so they're trying to predict like where the economy is going to go, where the industry they're operating in is going to go, where interest rates are going to go. These index funds and index ETFs don't do that. They just buy and hold essentially the either a subset or the entire set of the index they're trying to emulate. That's a lot easier work to do, so they don't need specialists to try to predict interest rates, so they don't need economists on their staff. They don't need people who can translate financial statements from other languages, people who understand the accounting policies of other countries. They don't need all of that. So they can they save money by not needing those people on staff, so they pass along those savings to us as shareholders. Just kind of as a fun thing to do, let's take a look though at this VFI and X. They only charge 0.17%, but that's 0.17% of a huge number. So I'm going to go back over here and let's see how much money's invested in the Vanguard 500. Oh, it's not as large as I thought. It's $39 billion. So if I pop my calculator over here, they're managing $39 billion. I believe I've got enough zeros there. And they're charging 0.0017. So that's 0.17% as a decimal. So they're making in management fees $66,300,000 a year. And that's just this year. Next year, if more people put more money in, or if the stock market rises and they earn higher returns and that boosts the value of the assets, they'll make more. So even though they should only charge 0.17%, they're still making millions of dollars. So I'm not actually going to type that in. They also may charge something called a 12B1 fee, and it's called 12B1 because of the paragraph in the law that was passed that allow mutual funds to charge this fee. But basically, it's a fee that may be charged to current shareholders to cover advertising the fund and distributing its shares. And again, not every fund charges one. So if I go to look at the Vanguard 500, if I go to expense, down here they'll tell you what the 12B1 fee is, and this one does not have one. But if I go look at the Vice X fund, down here they do charge a 12B1 fee. That's charged every year. It's built into the expense ratio. And then every fund will also have legal and accounting fees and administrative fees. And so they'll build these three fees, which I will highlight in, I guess, green. Every fund's going to have a management fee. Every fund's going to have legal and accounting fees. And then a fund may or may not have a 12B1 fee. But these fees in green represent the annual expense ratio that you'll see reported on Morningstar. So I'll just highlight that with green. So every time I've been looking up on the quote section, this expense ratio that includes a 12B1 fee if they charge it, the annual management fee, and the legal and accounting fees. Now, every fund is nowadays required to report, like in dollar amounts, how your fees will add up if you hold the fund for a certain period of time. So if I go to the expense tab on Morningstar for a fund, I'm choosing the Vanguard 500, and if I scroll down to this section, I see the total cost projections. It used to be funds would just report their fees as a percentage, like that 0.17% is their expense ratio, and they'd report their load fee as 5.25% if they had one. But I don't know, maybe 20 years ago or so, they were required to report the information as dollar amounts, just to give consumers or potential investors more of a feel for how much this was actually going to cost them in dollars. And so in this section, they provide a standardized investment amount because your fee would be different if you invested $50,000 versus if you only invested $3,000. So what they have done is projected what your costs will be if you invest $10,000, so it's per $10,000, and if the fund generated a return of 5% before fees. And that's just the way they've standardized it. And so if I can look at any fund on Morningstar in their total cost projections and know that hey, they've used $10,000 as our starting value and a 5% return each year before fees. That's how they calculated these numbers. So I want to show you exactly how they did it. And I I'll go ahead and do that in Word. So I've got an example already set up. So for VFIX, their annual expense ratio is 0.17%. We're going to assume a $10,000 starting investment and a 5% annual return before fees. So what I want to do is calculate the fees paid over a 3-year time period. And I'm going to set up a little table to do that. So I'm just going to tally the years and my beginning amount, my ending amount before fees, and then my fee, and my ending amount after fees. So the at the beginning of the first year, I started with 10,000. Well, the standardized rate of return that Morningstar assumes is 5%. So how much will I have after fees? Well, that's just a future value of a lump sum calculation. And the formula, I'm just going to type it right here. The formula is future value equals present value times 1 plus the rate, or I, raised to the power of time, or n, for number of periods. So that's an exponent. So I'm going to use this formula to crunch the ending amount before fees. So my 10,000 is my starting amount. Multiply that by 1 plus the rate. The rate is that 5%, so I convert it to a decimal, add it to 1, and then I want to raise it to the power of 1 because I'm only keeping it in there for a year. And technically, since I'm raising it to the power of 1, I don't really need to put that, but I will put that the first time. That gives me, let's see, 10,500. My fee is based on that 10,500. So my fee is going to be the 10,500 times 0.0017. That is equal to, I'm trying to get it to wrap around. There we go. It's equal to $17.85. That's not a bad fee for a $10,500 investment. And so my ending amount after fees would be this 10,500 minus this, minus the 1785, which is equal to 10,483. The second year, my beginning amount is equal to my first year's ending amount, so 10,483. My ending amount before fees for the second year will be 10,483 times the 5% standardized rate that they're saying we're earning, raised to the power of 1, which I'm not going to put. But that gives me $11,007. And then I take the $11,007, multiply it by the 0.0017, That gives me an annual fee that year of $18.71. And see, even though the ratio stayed at 7.17%, because my dollar amount has increased, my dollar amount of my investment has increased, the dollar amount of my fee has gone up too. But it's still just 0.17% of my value, but my value's risen. So my ending amount after fees will be the $11,007 minus the 1871, which is $10,989 if I'm doing all my math right. And then the third year, I would start with 10,989, then multiply that by 1.05 to the power of 1, which gives me 11,538. Then take that amount, multiply it by the 0.0017%, gives me a fee that year of $19.61. Take that amount from my 11,538 and I get 11,518. That is my ending wealth. This is my starting wealth. Um, that's a rather long way of showing this to you, but what I also want to do is sum the values in this column. So I want to sum the 1785, the 1871, and the 1961. And so I'm going to just say sum equals $56. That is well, we've got some rounding issues here, but that's this $55 that Morningstar reported. And if I'd done this process for 5 years and then summed that column, I would get 96. And if I'd done it for 10 years and summed the column, I'd get 217. But that's how they crunch it. There's a slightly easier way to do it, and I'm going to go ahead and show it to you because I always think it's good to improve your understanding of things. So an easier way, what I could do is calculate the annual return after the fee. I know I'm earning 5% before the fee, and I know I'm paying 0.17% each year in fees, so my annual return after the fee is 4.83%. And what I can do is take that $1,000, multiply it by 1 plus this 4.83% for 3 years. So this time I do care about the exponent because it's more than 1. And that should give me $11,520.11. And we've got some rounding issues that should be the same as this. I'm not sure where my rounding issues are. It's probably here is more likely where I rounded versus here. But at any rate, then what I can do is compare the 11,520.11 to how much I'd have if I didn't have to pay any fees at all. So if I didn't pay any fees at all, I would have invested the entire 10,000. I would have earned 5% on that. Just going to copy this for 3 years, and that would be worth $11,576.25. So if I take the 11,576.25 and subtract the 11,520.11, that gives me a difference of $56, which is this 56. Now, there are some fees that are not reported on the financial statements. And I think what I'll actually do is start a new video to talk about those.